Holy smokes, we have breaking news. Joe Biden says he is not going to enact the Taft-Hartley Act of 1947, which would force port strikers back to work. This means potentially dire effects on the economy that could start to be realized within the next coming days. I mean, this strike is affecting 50% of all things that are shipped from and to America. That is crazy. And I find it even crazier that nobody on Wall Street is paying attention to this. Like it's just another auto union strike or another Boeing strike or something that's benign in nature. This is not benign. This is bad. Like very bad. Now here in this video, even though things are bad and I'm a bear, I'm still buying stocks, which is crazy, right? A bear buying stocks. Who in the world thought that was possible? Yes, in fact, I have bought a lot of stocks in the last couple of weeks. These are stocks that I feel very confident in long term, whether or not we go, you know, into a recession or whether or not we do see a booming economy. After all, we are expecting a booming economy. If we get that boom economy, these stocks are going to benefit more than Apple. They're going to benefit more than Nvidia. They're going to benefit more than Google and some of your other big tech stocks that seem to be dominating people's portfolios. And on a balance of risk to reward, I really like these stocks that I will share with you towards the end of this video. So stay tuned for that. So first things first, let's start at the top of this video. President Joe Biden has said he will not intervene to force striking ILA union workers back on the job at East and Gulf Coast ports. This article from CNBC goes on to say, a political calculation that balances the power of unions ahead of a tight election with concerns about the economy, the #1 issue for many voters. I mean, let's face the facts here. When the economic damage becomes so large that you can't turn a blind eye to it, Biden will enact this order and force port workers back to work, regardless. Balancing act right now, okay? From a political standpoint, if you cave in right now and you force these union workers back to work, then other unions, auto unions, air unions, right? There's so many different unions, it's stupid. Then you could possibly turn that union vote that was favoring a Democratic presidency for this upcoming election more to a Republican presidency when maybe the economic damage was not too bad, where it makes sense to just let them strike. But let me tell you right now, when the economy starts to falter and people start to lose their jobs and the pain becomes too much, economically speaking, then Joe Biden will force them back to work. Because the calculus to that is, hey, we may lose some of the union workers, but we're going to lose basically everyone if this economy is plummeting, heading into the recession, which, by my timeline, if these port workers strike for another 30 days or so, by a month from now, the economy is going to be in a very bad place. Kind of the catch-22 to this, if you're an investor and you're concerned about this, you're thinking about this, the problem really is, by the time Biden steps in and forces them back to work, the damage is already going to be done. For every day these port strikers or workers are striking, it's going to take anywhere from 3 to 7 days to clear up the mess, the contagion that is being caused right now. And tomorrow is going to be day number 3. So as is, you're looking at 10 to 14 days to clear up the mess in the ports if the strike were to end like tomorrow night. So from an equity investor perspective, this is just not a good situation. Either way you put it. If the economy was really as strong as some on Wall Street believe, then I think the economy would be able to weather a couple of weeks shutdown of the ports. But with the economy as weak as it is right now, this is a tipping factor that could push the economy into a recession. And I think as a grossly generalized statement, not enough people on Wall Street are talking about this, nor concerned about this. I really think this port strike is something that could come back around on the back end and slap a lot of Wall Street in the face. What I mean by that is one day we may wake up and Walmart or someone else lowers guidance because of this port strike. And then Wall Street's going to say, oh my God, how many other companies are affected by this? We had no idea. And the whole time I've been talking about it here on YouTube. That's what I mean by getting slapped in the face. Like literally just one day you will see a company come out and slap the markets in the face. And then we'll start talking about how much damage has been done from this strike. At the same time, again, we still have Goldman Sachs that suggest there's 6,000 target on the SPX. That is 600 on the SPY. If you use the SPY ticker instead of the SPX, which I do myself, is too low by the end of the year. I mean, whoever thought markets could fall? I mean, that's just a new thing these days. Markets don't fall. I mean, what are you talking about? I mean, that's kind of how it feels when you talk to people on Wall Street. There's just no semblance of a downside risk at all anymore. Okay, now in the next 60 seconds or so, I will briefly run through the major companies' earnings we have gotten so far to start Q3 and just how bad they are. The first red flag was FedEx. FedEx stock plummeted after an earnings miss. Lower outlook flashes warning on the economy. FedEx was by far the most alarming earnings of the start of this earnings season. FedEx is seen as a bellwether company, and if FedEx is doing bad, then the economy is doing bad. Oh yeah, and it says right here, FedEx, which is often viewed as a bellwether for the economy. FedEx reported profits of $892 million, about 24% lower than analysts anticipated for its fiscal first quarter, ended August 31st. The company also lowered its fiscal outlook for the fiscal year ahead, projecting earnings per share between $20 and $21 versus its prior range of $20 to $22. And FedEx at the time, this was the day after the Fed cut rates. The Fed cut rates on September 18th. FedEx reported earnings on September 19th. They said, quote, the magnitude of the Fed rate cut yesterday signals the weakness of the current environment. Again, this is something that you are not going to hear from fund managers on Wall Street. They're not going to talk about the bad. You see this. They are not talking about the bad. They are in Delulu land. Now, do you blame them for being in Delulu land? Like, come on. If you really were going to say, hey, do I want to be honest with markets and make 30% less money for my family? Or do I just want to follow the Delulu train and make 30% more for my family? You would probably follow the Delulu train and make more for your family. I think most people would go with that. I wouldn't, because, I mean, let's be honest, more people are going to like the bullish videos right now than bearish videos. Clearly, that's just not right. I don't think it's a generalized good principle to lie to other people. But why Wall Street is lying to you is because think about like 08 or 2020. When you scare people, when the recession word comes out, people don't invest their money. In fact, they do the opposite. They sell, they take their money out of their, investment advisors' hands, right? They want to take their money back and prevent themselves from losing it. The reason a lot of people don't get rich in stocks is because, well, not because they don't have money. It's actually because they don't want to take risk, okay? People don't like to take risk. If you are someone that is willing to take more risk, you will get paid more. You will make more in your lifetime in markets because high risk, high reward. Low risk, low reward. It's as simple as that. I mean, that's the same thing that happened in 2008 in the dot-com bubble. Like, there is precedence around what I'm saying. This is not a new thing that just started. Whenever the economy weakens, whenever there is a real risk of a recession, people tend to get very bullish, right? People tend to spread that bullish narrative, again, because fund managers make more when you are bullish rather than when you are scared or bearish. That's usually why you've probably heard this before. When everyone's bullish, you want to be a little defensive. When everyone's bearish, it's it's probably a good time to buy. Now, next up, we have Stellantis. Stellantis has not reported earnings, but they did issue guidance that was, quote, so bad, Ford and GM stocks are also getting hit. Stellantis previously seen full-year adjusted operating income margins coming in between 5.5% to 7%, down from prior call for double digits. Free cash flow is now expected to be negative 5 billion euros, about 5.6 billion, to 11.2 billion from a prior expectation of positive free cash flow. Huh? So you were expecting to make money and have cash flow, but now you're expecting to lose 5.6 to 11.2 billion? It's not a good sign for the state of the consumer. Darden Restaurants, they own Olive Garden and Longhorn Steakhouse. They didn't have terrible earnings. Total sales were 1% higher last quarter than 2023. Same-store restaurant sales decreased by 1.1%. Diluted EPS came in slightly below last year. Margins were lower. Free cash flow was lower, right? Just not great earnings to, again, justify market's expectations. And then you have Nike over here that won't even give guidance. I mean, they beat on EPS, expecting 52 cents a share. They came in at 70 cents a share, but their headline revenue missed expectations. It came in at 11.59 billion. The estimate was 11.65 billion and was down 10% from a year earlier. Even Costco, they beat on EPS. Revenue increased only about 1%, which was a little bit lower than expected by about $300 million. You did see some other weaker metrics from Costco, like overall comparable sales that rose 5.4% for the quarter, below forecast for 5.7% growth, and US same-store sales that rose 5.3%. They also said the 2025 earnings growth is likely to be less linear than analysts would typically expect, so slower EPS growth. I mean, my point here really is we've only gotten a couple of companies that have reported earnings so far, and of the ones we've gotten, none of them have been good besides Micron, that is in the whole AI semiconductor stratosphere. You also have Levi's just today that trims guidance as it weighs a sale of Docker's business. Levi's is currently down about 10% in after hours. Earnings per share came in at 33 cents versus 31 cents expected. Revenue missed, came in at 1.52 billion versus 1.55 billion. Levi's posted $757.2 million in sales for the Americas, below the $789.2 million the street account analyst had expected. I mean, again, to the point, these are just not great earnings we're seeing. It definitely doesn't support 20% EPS growth year over year. Now, take a listen to this clip, again, where Lauren Goodwin says the economy is walking on a tightrope.
And so the balance beam is less about teetering off into an abyss and more about how does the market absorb the reasonable economic data that we have. So, for example, a weaker than expected jobs report, that's likely to be a concern for growth, potentially volatility in risk assets, maybe expectations that the Fed might cut a little faster. Whereas even just a little smidge of data in the opposite direction gets you the exact opposite result. That's a challenging environment for anyone who's trying to invest for longer than a day. And so that's the tightrope that I see really more for risk asset.
But what if we just say, you know, net, you've been using the word distill a lot lately, I have, because there's a lot out there, but some would distill it all down and say, Fed's cutting, economy's still good, and that's really, at the end of the day, those are the two most important things that matter more than anything else. We get that good news is good news and bad news is bad news. A bad jobs report would obviously be concerning, but net, cutting, still strong, that's what matters.
I tend to agree with that. And so if the economy is still strong or resilient, let's say, and the Fed's cutting, what do? I mean, the number one concern for investors then becomes reinvestment risk.
Hey, don't you buy equities?
I think that you buy risk assets, but I strongly prefer credit. And the reason is not that I think equities are going to do poorly in this environment, but that the upside relative.
Now, this is the part where I was like, okay, That sounds more like what I've been saying to you guys.
To credit is limited, and that's because both assets have really performed quite well on a price or valuation level. And so the question for investors becomes, how can you generate income and manage what might be, again, a sort of a middling, still reasonable, but middling risk asset performance over the next couple of quarters. And so that's why, from our perspective, credit is such an interesting opportunity. And where equity is concerned, rate cuts really are still a big part of that story. When some of the structural themes that we've thought are really interesting around the semiconductor supply chain, around energy, those are sectors that tend to do well when rates are moving lower. And so it's really a commingled story between debt and equity.
I mean, there are others, there are plenty of people, by the way, who agree with you. I think Rick Rieder sat in that chair and made the case that, look, a lot is in the equity market already. There's a lot of good news priced in. Valuations are rich. They may not be too rich, but they're rich nonetheless. Thus, the better risk reward right now is in credit. I know he's a credit guy, or certainly he's the CIO of fixed income at BlackRock, the world's largest asset manager, but he is head of the global asset allocation team too, so he thinks about stocks. But the point is the same, that a lot's in the stock market and the better risk rewards in credit. And you agree?
I do agree. Now, for investors that are looking for equity market ideas, there's a couple of areas where I think are really interesting to play. I just mentioned that some of the secular themes around semiconductors, around energy, those are the sectors that tend to benefit as well from the cyclical reality that's cutting rates. So those are high conviction opportunities from my perspective. They also are likely to be relatively supported regardless of what happens in November. And I see a lot of investors waiting until November to make big allocation moves.
You feel like this market's kind of been a little choppy. It hasn't been a tremendous amount of activity. Do you think this is a precursor for what we should expect now up until for the next 30 plus days, almost 40 days?
Yeah, I think that's the case. Now, when it comes to what difference will the election make, a couple of things. First, I think if we have a sweep in either direction, that's a +1 for growth, inflation, and potentially for rates. So I do expect that the market is going to have to adjust over time this rate cutting expectation down a little bit, meaning the Fed will have to cut a little less than the market thinks. That would be accelerated by a sweep scenario. Other themes that we're looking at, the president. Whoever's in charge has the right to levy tariffs, regardless of who's in Congress. And so that's another potential inflationary risk. We're looking at that. But sectors are something that we actually think some of the old sector norms around Republicans versus Democrats not likely to apply this time around. Both candidates have moved differently from the past as much as they're different from each other.
Okay, let me simplify that a little bit. She said the risk to reward in markets is not that attractive. Like if the economy slows too much, we could see material downside from here. If the economy does well and beats expectations, we're already pretty much priced for that. And that's exactly what I've been saying here on the channel. It's not really the risk that the economy falls out of bed and things go to shit tomorrow. It's the chance that the economy just doesn't do that great. And we're priced for greatness. Like, that is the problem with markets right now. She also says that credit makes more sense because, again, in some areas of our markets, there has been more recession risk priced into them, whereas the headline S&P has priced in zero recession risk. And last but not least, she did say over the next couple of quarters, risk assets could be under pressure, again, if the economy does start to slow more. So now I really want to show you guys some of the stocks that I have been investing in a little bit more heavily over the past couple of weeks. These are stocks that I believe will outperform if the economy does well. And I believe these are stocks that have already baked in a lot of bad news. So even if the economy does okay, these stocks can also do well. And it kind of has a little bit to do with the credit argument that she was also making, because many of these stocks are paying 4 to 5% dividends. Now, I also think many of the dividend stocks are really not that sexy. They're overlooked, they're underappreciated right now, and really have been for years. And most of these stocks that I'm going to share with you are cyclical companies. They are companies that benefit when the Fed, well, cuts rates. and when the economy does okay, does better than expected, the AKA soft landing. Stock that I bought today just because it was almost a no-brainer was Humana. Okay, now this stock pays less than a 2% dividend, so I don't think there's like the dividend factor here, but I do think it's a great value right now. It was down 25% at one point. I got in at $226 per share, up almost 9%. Just bought this stock today. I do think there is a fair bit of bad news priced into Humana. About 20 shares of this company, and currently I have almost $5,000 invested in them. The stock next up on this list may be one that you wouldn't expect, and it's actually Whirlpool. Okay, Whirlpool pays a 6.5% dividend. They have a very low payout ratio. The dividend looks safe from that metric. And if what happens, if real estate starts to pick up, which is an upside scenario in my mind, really the only upside scenario for this economy, Whirlpool is going to massively benefit from that. As I've shared with you guys here on this channel, the amount of homes listed is up 300%, and mortgage demand really hasn't picked up at all. If mortgage demand starts to pick up and we start to see the real estate market moving again, just the quantity of homes start to increase and start to be bought, you know, more bought and sold more frequently, Whirlpool is going to benefit massively from that. And I do think, given the stock, you know, hasn't really done anything in years, I mean, you're buying this stock back at prices you haven't seen since 2013, since 2012. I don't think Whirlpool is going anywhere. I like the 6.5% yield. And as real estate picks up, this is a stock that could easily outperform in a soft landing scenario. And I think there's a lot of bad news already baked into Whirlpool. I bought 30 shares of Whirlpool for about $3,300 or so. Now, another one that I recently bought, I believe I bought this a couple of weeks ago, around August 13th, 15th, and the 15th, I did all of these purchases. Currently own about 70 shares in CVS. Currently up about 10.3%. I bought this right before the recent news came out about activist investors taking a stake in CVS, pushing the management to make some changes. There's word about a potential spinoff of CVS. Another one of those stocks that's cheap. It's not going anywhere because CVS really runs, it's called a PMO. It's basically the middleman between pharmacies and insurance companies that negotiate drug prices. This stock pays a 4.22% dividend. So again, as the Fed cuts rates and those shorter term treasuries fall in yield, that's going to be valuation support for CVS. And currently have about $4,300 in this one that I just recently started to buy. I did also recently buy Nike. Now Nike is one of those stocks that has a lot of bad news priced into it, I would say. Could it fall more? Yes, absolutely. If we were to go into a recession, Nike would fall more. Probably more than the other stocks that I've talked about so far, but I do think there's a fair bit of bad news already priced in. Nike does pay about a 1.66% dividend, and I think with a new CEO, there is room for Nike to excel. But you can kind of tell my confidence in these names by the amount of money I put in them. Nike, I'm up 2%. I own 25 shares that I recently bought, worth about $2,000. Nike was one of the smaller purchases. Now, another stock that I recently plowed a lot of money into was Dollar General. This is one of my favorite companies because I don't think they're going anywhere. I think they are in deep effing value territory. I mean, you're buying Dollar General, you know, back 2015 type levels. And there's been a lot of money printing. There's a lot more money in circulation. When the consumer does get better, really recession or not, Dollar General is going to outperform. And if we truly do have a soft landing like the markets are expecting, Dollar General will do very well. You could see it's cheaper than it's really ever been before. Price to earnings ratio only 13 with a almost 3% dividend. So the same argument could be made there. By the end of 2025, Dollar General is going to look more attractive if it's still trading at current prices, which, you know, who knows where the federal funds rate is going to go. But nonetheless, a little bit of valuation support there with the dividend. Bought 80 shares recently, down about 16%. So this is one of the ones that I am still down on. I believe the only one out of this list so far I'm still down on, down 16%, market value of about $6,500. Last but not least, I did buy some Applied Digital. Now I like this company. I've been doing more research into this company. I think it's going to do well, but it is trading at almost a 1-year high. Which I think this is now a 1-year high or pretty close to that. And it has seen one hell of a run up as of recently. So I really just started a small position to keep my eye on it. Only about $400 up about 3%, bought 50 shares at an average cost of $8. If this thing falls in any kind of material way, I'm going to load up on this name because they are developing one of the largest data centers in which they're going to rent out servers. And NVIDIA also recently took a stake in them. So that is part of the recent hype in the name. I do think this has more potential than some of the others as far as a potential return, but the risk is definitely a lot higher. And the last thing you want to do is go all in and top ticket after it just went up 200% in less than a month. So again, I show you some of those recent, purchases to kind of show I am investing in this market still. I do have cash on the sidelines, got about $25,000 roughly in cash on the sidelines just in that portfolio. Got another $60,000, $80,000 ready to go in other portfolios. That's just the portfolio I'm trying to build out really right now. So I'm ready to capitalize on any downside in markets. I want to keep that cash level high, but I also want to invest in areas that are really a win-win no matter what happens, okay? As minus any severe deep recession, which is really not my call anyways, but more so the economy just slows, goes close to a recession, maybe dips into a recession. I don't think we're going to get a super deep recession unless we get a catalyst for that, which could be the rail strike, but we don't know how long that's going to last, so I'm not confident to make that call as of now. I'm watching that very closely. If that goes on for an extended period of time, then yeah, maybe the rail strike is that catalyst that pushes us into a deep recession. But I think these areas are the underappreciated areas. They have a lot of sound reasons to own them. They're companies we have all heard of before. Besides Applied Digital, that one's not really a blue chip, if you will. That's a kind of smaller company, higher risk, high reward again. I feel confident in these areas. Small caps, select small caps, dividend stocks, value, which all of those stocks are deep value besides Applied Digital. So let me know what you think about this information down below in the comment section. Hit the like button and subscribe to the channel. Let me know down below in the comment section what you are investing in as of lately. I would love your opinions and feedback. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.